So what is a commercial mortgage? Well, I'm James Blacklaws, and let me tell you. A commercial mortgage is simply a loan secured against the property which a business is trading from. So, you live in your house, you have a loan against that house, first charge loan, that's a mortgage. A business mortgage is exactly the same. It is a first charge against the property you're trading from. So, that can be done by a purchase. So a business is looking to buy a property for the first time or grow from the property they're currently in. They want to borrow money against that to facilitate the purchase. That's a commercial mortgage. A commercial mortgage is usually over a period between 15 and 25 years, depending on the nature of the property, the nature of the business, and the current kind of appetite for this lending in the market. That's the sort of general term. 15 years for maybe a retailer, 25 years for a more generic, easily converted property. Interest rates on these can vary wildly, and a lot of that's due to the market climate, a lot of that's due to the customer. So, a customer's interest rate anywhere from 2% over the Bank of England base rate for a very, very low risk customer who's borrowing a relatively small amount against the value of the property, to somewhere around about 6-7% if the client is seen as high risk. Maybe there's some adverse credit history in the background, maybe it's a sector which a lot of lenders aren't so comfortable with, a retailer or a pub, etc. So there's quite a wide variety there. The key thing though with commercial mortgages is what we call the loan to value, and I touched on it a minute ago. It is the amount of borrowing against the value of the property. Traditionally, in residential mortgage world, you can borrow 90%, 95%. If you're Northern Rock, 120% back in the day against the value of the property. With commercial finance, it's always been much more restricted, and that is because it is seen as a high risk transaction. The kind of industry standard is 70%. So if a property is worth £100,000, you can borrow 70% against it, and that's seen as generally the maximum exposure of a bank. Now there has been a bit of loosening on this. Some banks will go to 75, even 80% if the deal is absolutely right. And certainly some secondary lenders will go to the 75-80% mark, but they will obviously charge for the privilege. So it's generally in your interest if you can borrow at sort of 60-65%, because you're generally going to guarantee to get the best rate possible, the lower end of that sort of scale I was talking about. So that's how a commercial mortgage works. Generally they're capital repayment, which means that the interest only option isn't normally there unless there's a very good reason for it. This is to make sure that if there is a property value dip, that the loan is coming down and down and down, which reduces the bank's exposure on a monthly basis. It's just good common sense, and to be perfectly honest, unless there's a good reason for it, you probably should be paying your mortgage back, capital and interest, whether it's residential or whether it's commercial. So that's a very, very brief overview of commercial mortgages, how they work. A guy like myself, any broker, has got access not only to the high street banks, but also the secondary lenders, and then the third tier lenders as well. So you've got a whole wide suite of commercial mortgages available. So if you're a brilliant customer looking to borrow at a low loan to value and you've got great profits, brilliant. If you're not one of those customers and you're looking to consolidate what you've got, you're looking to borrow a little bit more but your bank have turned around and said no to you, then please get in touch, because just because your bank have turned you down doesn't mean there's not options available for you. Get in touch, like, share this video. I'm James Blacklaws, JB Commercial Finance. Thanks for your time.